We've just crossed into uncharted territory. An OG and hedge fund manager said that we just tripped a major wire that requires the Fed to act, unless it risks the entire system collapsing. He says that it holds too few bank reserves relative to GDP in order to maintain a healthy system. Excess liquidity in the system is drying up at record pace. The Fed's repo facilities, its shock absorbers, are down 99% and have just $5 billion in reserves. What does this mean? I thought that we had a capitalistic system. I thought that we had free markets. No, they always need to intervene. The system is a Ponzi, and we will cover exactly what the Fed and the Treasury is going to need to do in order to cover up the holes between now and midterm elections. This is Dante Cook with Bitcoin Simply. Let's go. All right, let's get started with the juicy news. Hedge fund manager and OG James Lavish put out a fire newsletter in his publication, The Informationist, this morning. He basically laid out the case for why the Fed is screwed, why liquidity is drying up, and what's going to happen next. The reverse repo facility, basically the Fed's shock absorber, is down 99% from trillions of dollars to just $5 billion over the last several years. In fact, it's fallen from $600 billion to just $5 billion today, and that's just in a matter of 10 months. At the same time, he highlights that bank reserves are down and are dwindling. They've fallen by over $1 trillion in the last 2 years. This is money that the banks hold in reserve at the Fed. And he goes on to highlight another crucial fact. The spread between the SOFR, or the overnight Fed funds rate, and the effective federal funds rate is blowing out, which means that there's less liquidity in the system and people are unwilling to take free money when it's offered to them. And if we're starting to figure this out, it's a fact that Jerome Powell knows that this is happening too, which is why he probably is signaling that we're moving from quantitative tightening to quantitative easing. The Fed has no choice but to print. It can do this several ways: increasing the money supply broadly into the markets. They can raise capital by raising the repo rates, allowing the banks to earn more money on the money that they're able to print out of thin air, which they will use to buy treasuries to fund the debt that the United States government has. Another form of printing. Oh yeah, because the United States government is burdened with debt. $37.9 trillion worth of debt. It's grown $1.7 trillion since the ceiling was lifted in July. That's $425 billion every month, or $25 billion a day, roughly. The train isn't stopping, and this was explained in an awesome clip and segment from a great episode that happens every Friday between Jordy Visser and Anthony Pompliano. Jordy Visser lays out exactly what's going on and what James Lavish explained in his newsletter.
This is part of fiscal dominance. This is what you have to understand. I don't even know the best way to describe it because there's a lot of terms like SOFR, the standing repo facility. Let's just say you're a homeowner and all of a sudden you have a lot of bills coming at the same time and you're scrambling to get cash because you don't have enough cash sitting around. That's kind of where the financial system is right now in the US. There's a certain threshold level of where bank reserves need to be. And if it goes below that, the banks will have to kind of rush for cash and go through it. So there's been this pressure, which normally happens every quarter end, but it's happened now. And I think part of the reason it's happened now is because of the first brands in tricolor, which when you're really tight to the level, you end up with a lot of kind of people scrambling around. So all of a sudden, SOFR, which has to do with overnight, let's say collateral-backed securities, the spread has gotten extremely high, which says there's problems going on. Jerome Powell said this week, we're probably going to have to stop QT. So for everyone out there that's
got him
kind of freaking out, the problem is, guess what?
Checkmate.
You got the Fed, QT, they're buying the bonds from the Treasury, and the Treasury needs to issue lots of debt because the debt didn't get any better this year. So remember, when we started the year, there's a debt deficit, problem. We did Doge, all this stuff. Nothing has solved the problem. And so we have these revenues coming in on the tariff. That's all well and good, but we still have the Treasury issuing lots. And this gets back into the Michael Howell thing, which is we have a lot due this year. We have a lot due next year. And so this puts pressure onto the Fed, and that's why they can't let the runoff happen anymore. And that just means that they're going to be in the market easing liquidity whenever these happen. So I don't think this is a one-off shock, because what's causing the first brands in the tricolor? It's the K-shaped economy. We have a problem, guys. And unless the labor market gets better, which is not going to happen with AI, into the midterm elections, they're going to have to juice the system. Another reason to be positive on Bitcoin.
So regional banks?
We all know that this leads to money printing. We all know that the system is a Ponzi and that the winners are predetermined. We live in a K-shaped economy. And the government is so large that it cannot let the system fail. The system is financialized and the system is the equity markets. They cannot crash. We must move to a new system, not through collapse, but through a slow and gentle deflation into another system completely. And we know what that new system is going to be.
The fiat system is a Ponzi scheme. It is.
Of course.
But the government was $7 trillion of debt in 2007 when Michael Burry challenged the system, when George Soros challenged the system, or Druckenmiller challenged the system. They were big relative to the system. Now the government is $37 trillion. It's 120% of GDP. They can't allow it to go under, and they have tools that were created. We still have QT. We weren't supposed to have QE for more than a year after we did it. Bernanke told us it wouldn't be here. So for everyone kind of going through this, unfortunately for all of you, it is not only a Ponzi scheme, but the end game is not at crashing. The end game is it being replaced by the new system. The new system is stablecoins. The new system is Bitcoin. The new system is tokenization. All of this is coming, and next year is going to be a boom year for all of those things.
Right now, that system has rewarded the people who own the hardest assets in the 20th century, which is gold, which has been the best performing asset over the past 20 years, minus Bitcoin. Over the last 2 years, gold has moved from 4% to 6% of all investable assets. But before, it was at 22% of investable assets, meaning that the world has moved away from its desire to want hard and scarce assets. And people still don't seem to understand the importance of hard and scarce assets. Listen to this clip between Andrew Ross Sorkin, Bill Maher, and Mark Cuban.
Gold prices hit records high this week. Oh, they did?
Yes, they did.
Oh, and that didn't sound good.
That's not a good sign. Usually gold goes up.
It's good if you're decorating the White House.
Gold goes up when you're worried about the value of the dollar going down. That's the equation.
What has the dollar done?
But people go to gold when they are scared, right?
Yes.
It's so crazy. Gold. I mean, it's so antiquated.
I mean, what are you going to do with gold, right? Walk around with a bar and hit somebody over the head? No. And then we say, no.
And also, like, I mean, I think I have some gold in my portfolio. I don't actually have it in my, right? It just says, it's still something just right on.
Right, it's still digital, right? Yeah.
Right. It's still like I own gold.
Okay,
Like I said, gold has performed fantastically. It's outperformed every asset in the market over the last 20 years, except Bitcoin. And the numbers aren't even close. And that's because we're transitioning between analog assets to digital assets, from physical capital to digital capital. And the world is yet to understand that Bitcoin is going to be the big winner from this. The sky is the limit. We haven't even been close to a stimulatory environment since Donald Trump has taken office. We've had high CPI prints instead of low CPI prints. We've had tariffs instead of tax cuts. We've had wars instead of peace. With AI going to increase productivity and earnings in these publicly traded companies, the sky is the limit for what's going to happen, in addition to the Fed entering into a QE policy. The race is going to be on to acquire more Bitcoin, and there will be a new price discovery that we can't even fathom right now. When this price discovery happens, it's going to happen quickly.
The reason I'm buying Bitcoin is because I think when we get through the all-time highs again and basically get rid of this 4-year cycle belief, now there's no imaginary place for people to ever again care about. And that's normally what happens in equity markets. And oh, by the way, 2017 was the end of the Donald Trump tax cuts. Well, we've had tariffs this year. We've had bad stuff happen this year. The equity market in 18 was bad. At one point, it was down 20% year to date in December. In 2022, the equity market was down. So the one thing about the Bitcoin halving cycle, it seems to have been trading with traditional finance markets. So when you say that Bitcoin's 4-year cycle is going to play out next year, you're also embeddedly saying you don't believe in AI and you don't believe profit margins are coming and you don't believe the earnings are going to be higher and the S&P is going to go higher.
And you don't believe that the Fed's going to cut interest rates.
Yeah, exactly. The Fed's going to cut rates.
But it's not going to come without volatility, something that Samson Mow calls his Max Payne theory, and that the biggest winners are going to be the people that are able to most tolerate those extreme levels of volatility. But we'll get to that right after the break. If you've been stacking Bitcoin relentlessly over the past several years but don't want to let go of your Bitcoin, well, you're not alone. And that's why Ledn was created, for people like you who don't want to sell their Bitcoin but want to borrow against the value that's been created in purchasing their Bitcoin. You're able to secure Bitcoin-backed loans that pay out in fiat up to 50% loan to value. So if you want a $1,000 fiat loan, you post $2,000 in Bitcoin collateral. Fiat gets in your account in less than 6 hours. The application takes less than 2 minutes, and there's no credit checks. Rates start at just 12.4%, and your Bitcoin is held in cold storage and not rehypothecated in any way. Go to learn.ledn.io to get started with rates that start at just 12.4%, but you get 0.25% off your first loan by using the promo code SIMPLY or going to learn.ledn.io/simply. One of the ways you can continue to grow in your sovereignty is by removing your Bitcoin from exchanges. But don't do it alone. Schedule a free consultation with a coach who can help you to learn how to do this privately, safely, securely, and confidently so that you can pass down your Bitcoin to your children's children and future generations in a way that's safe, in a way that's proven, in a way that's reliable, and in a way that you can trust. A coach will help you to do this step by step. Schedule a free 30-minute consultation with the team at the Bitcoin Way by going to thebitcoinway.com/simplybitcoin.
I also have another theory called Max Payne theory. And that is like the most painful outcome for the most people is the most likely outcome. So if we think that Bitcoin volatility is always going to be low, and we just gradually step up to 1 million and to 10 and to dollar parity with sats, that is the best case for the world. Everyone has a long time frame to accumulate. Everyone has time to buy. And I don't think that's going to be the case. And I think a lot of people realize this. If you look at Saylor and Strategy, he's buying anytime. Like it doesn't matter if it's a top. He doesn't care about dips because there is this urgency because the time is running out to buy Bitcoin at these low prices. So we're going to see a fast run up, and gold is a good parallel for what we're likely to experience with Bitcoin. If you look at the picture circulating right now on the internet, there are people lining up, forming queues to buy gold, and gold is at an all-time high. So nobody wants Bitcoin when it's in the low 100Ks. But once we get to like $500,000 per Bitcoin, I think the world's going to wake up. Central banks are going to wake up, and nation states are going to start joining the race. And that's when you go to 1 million very quickly and beyond.
Samson mentioned Saylor in this clip, highlighting one simple fact that the people that tend to be the biggest winners are the ones that have a relentless focus and drive and are able to do a simple thing consistently over a long period of time. And that's why Michael Saylor says that the most important dot is always the next one. He continues to stack relentlessly. But Michael Saylor might be a little bit crazy for you. So here's a couple of other indicators to show you why the market is about to have a melt up before it has a meltdown. On Friday morning, the VIX jumped above 28. Every time that the VIX has jumped above 28 and it's been within 3% of all-time highs, well, we've had some fireworks afterwards. This happened in 1999, in 2020, in 2021. 1 year later, the market's up on average 21% after these sorts of events. And one other thing that tends to happen is that when gold runs, Bitcoin sprints. We've said this on the show a lot. But also when gold finds a local top or a new top, well, assets tend to rotate into Bitcoin. In fact, in 2020, when gold reached a local market top around $2,000 an ounce, well, a lot of that money rotated into Bitcoin, and Bitcoin was up 550% after gold reached that local top. Are we near a top in gold? That remains to be seen. But still, when gold runs, Bitcoin sprints. And gold has had a year for the ages. In fact, it's been its best performing year, up over 65% since 1979, when it was up over 126%. History doesn't repeat, but it rhymes, and it's leaving a lot of clues and making a good beat right now. It appears that through the end of this year and through the middle of next year, when midterm elections come around, there's a lot of reasons to be bullish on assets like Bitcoin. And why Bitcoin is most likely to be the biggest winner when it comes to QE, when it comes to the Fed being backed into the corner and needing to unleash liquidity into markets. When it goes to tax cuts from tariffs, the market is going to be incredibly stimulatory. And the hardest assets that also have a digital backing like Bitcoin are going to be the biggest winners. Don't overcomplicate the trade. Stay humble and stack sats. And continue to build this digital network and knowledge around Bitcoin in real life by going to conferences like the Mining Disrupt Conference in November, about a month from now. From November 11th through November 13th, some of the largest Bitcoin miners and manufacturers and keepers of the network are going to be down in Dallas, Texas. Most of them will likely have used the promo code SimplyBitcoin to get 20% off their ticket. But if you haven't done so, go ahead and do it. Use the promo code SimplyBitcoin for 20% off your ticket. And if you haven't already subscribed to the channel, do so. Share this video if you continue to get value from these episodes. This is Dante Cook with Bitcoin Simply. Happy stacking.